And I'd like to welcome my guest, Richard Fisher, former Dallas Federal Reserve Bank president and CEO. Richard, thank you for joining me. You just heard the soundbite. Was that a ringing non-endorsement in your opinion?
Yes, it was. I don't think anybody, and it's not just Chairman Powell, it's everybody on the FOMC is clearly stated that they realize there's more damage done by negative interest rates than positive impact. And by the way, Rick, I appreciate you putting up that picture of me because if you really could see me right now, I look like Bernie Sanders gone wrong.
Well, Richard, I have to push back just a little bit. I agree. After listening to that, let's let the market speak. And what I did was I went back and looked at several Fed Fund futures contracts from the contracts in November, December of this year and out in distant months. And what I noticed is that today's low, meaning if he really pushed hard on negative rates, these contracts should trend a bit lower. Their lows today are no lower than they've been yesterday and the day before. And what that tells me is he might have pushed back, but he certainly didn't remove or accentuate the negative aspects of other economies that have used and are still stuck in negative rates. I can't believe you thought that was a ringing non-endorsement. He basically made it sound as though the debate is ongoing. You really think there's a debate? You really think our banks, the toll keepers to all the liquidity, they're instrumental in every plan the Fed has initiated? They would certainly end up more like European banks, which means I might have more money in my wallet than they're worth.
Yeah. Well, first of all, even before the COVID virus, the only index in the world that was lower than it was in 2009, before things turned, is the European Banking Index. This is a destructive mechanism. And think of insurance companies. Already we're hearing reports that some insurance companies are unwilling to write new life policies. So negative interest rates, A, are damaging from that standpoint. B, have not worked. There's no definitive proof that they were, before COVID, that they worked to lift the European or the Japanese economies. And they did enormous damage.
And they create a horrible spiral, Richard. Let me interrupt you. You know, you mentioned insurance companies. You know, many of my friends before the coronavirus used to tell me that they have to buy so many bonds now to get any kind of kick. That's part of the distortion, that the lower interest rates go and the more long-term liabilities and assets are mismatched, the more the securities they buy, thus making everything go lower in yield, making the problem worse.
I agree with you. So I don't think they're going to adopt it. The markets may push yields because, again, further out in the curve, the markets are determining the shape of the yield curve. There's an enormous demand for dollar securities and for dollars in corporate cash pipelines. I think that's what's shaping the curve further out. But I just do not foresee the Federal Reserve going in this direction. In my 10 years, as I recall, at the FOMC, we talked about it once. It was an academic discussion led by Chairman Bernanke, and no one cottoned to the idea of the attractiveness of negative interest rates. I don't think that's changed.
Now, I personally think that Jay Powell and company are doing a very good job. This is a horrible thing we're living through. And I'd like to read something else that Chairman Jay Powell said, and I'd like to hear your thoughts on it. In terms of fiscal discipline, I absolutely believe that we must, and indeed we will eventually have to return to a stable fiscal path. That just means you have to get the economy growing faster than the debt. Listen, Richard, it's hard to argue with that, but since the last crisis, I'm not sure that any of that has occurred, and if it has, it's in small doses maybe here. It certainly hasn't occurred outside the U.S., and when you look at entitlements and some of the issues of solvency there, I just don't see it, and I don't see the Fed has enough leverage to make any of that happen. Your thoughts?
I think what you're hearing from Powell, he's the only adult in the room. He's got a franchise he needs to protect. And I understand the reason for saying that. As you know, I'm a big supporter of his. I think he's doing a very good job under intense focus and criticism. But once you let these horses out of the barn, it's very hard to get the fiscal authorities to rein them back in. But we also saw the difficulty of shrinking the balance sheet of the central bank, of the Federal Reserve, after expanding it significantly. So they're going to be cautious in the way they expand the balance sheet. They can do a lot of talking to the market forward guidance, which, as we saw recently, helped the fixed income market significantly without having to take significant action. But you're right, Rick. The fiscal authorities are a different animal entirely. And remember, as George Shultz used to say, the only difference between Democrats and Republicans in the Congress when it comes to spending money is Democrats enjoy it more. But both of them do it. So I am worried about that.
Richard
We'll
Fisher.
have to see if we can rein it back in.